Now, central banks of India in the latest monetary policy in September and further hiked repo rate to 5.9%, following which banks and NBFCs have been on rate hiking spree for deposits and loan. However, the savings account rates are not rising at the speed the home loan rates are rising. Nonetheless, it's on the upward trajectory, definitely. So, should investors consider investing in the most beloved and traditional financial instrument, fixed deposits now, or it is still advised to stay away from it and invest in liquid funds and ultra short-term debt funds? To help you make a wise decision on this, I'm joined by Pankaj Bansal, Chief Business Officer, bankbazaar.com. Pankaj, good evening. Welcome to the show. So clearly, we are not a fan of keeping your money in savings account, where also we are seeing that the interest rate are moving upwards. Obviously, not the speed is not as expected as we all want. But then definitely what we are witnessing here, that fixed deposits have become attractive for a lot of people. Even savings bank accounts have been attractive, Pankaj. So now within these two categories, fixed deposit or savings bank account, where should you actually park your money, or you think that you have better options considering the rates going up?
So, Kavita, I'll tell you, it all depends on the need basis in terms of the customer, what he needs. So, for example, if I need a liquidity, that is a saving account straightforward, because tomorrow I can just invest and I can withdraw the money without any issues. But if I need a return, obviously your FDs will give you a better yield in terms of the return that you expect. But yes, then the maturity will have to kick in. It could be, it could be 1 year, 3 years, 5 years, depending on the horizon of the particular instrument. But it's just a combination of the two. Either you need liquidity immediate, or you need return. If my answer is liquidity, please go ahead with the saving account. But if my answer is return, then obviously FD will be a better return even in today's scenario.
Sure. Tell me something, the benefit of interest rate hikes that one can see in liquid funds and ultra short-term debt funds, because here we are talking about arranging liquidity and arranging contingency fund. Even if people are seeing the savings bank account interest rates going up by a percent or so, which is just the beginning, this might just get better, and the trajectory is definitely upwards, Pankaj. But then if we just keep this aspect aside, fixed deposit, liquid funds, ultra short-term debt funds, how can one decide which is a better option for them, considering the upward trend in the interest rate and also considering the kind of liquidity options they have? Because we are just talking about contingency right now here.
Absolutely. So if you talk it about today, your FD rates starts from 3.5%, 4% and move to 5.5%. If I look at the return from a liquid fund today, it's like 5 to 6% on an average that we are looking at. And same with ultra debt funds also, probably the range is similar. But the concept is that in a liquid fund, you can do it within 91 days of investment. So there is no upward movement that you will see from a rate hike that will happen, because within 90 days, the maturity will come for a liquid fund and you can just withdraw it. If you want to repark it, story is different. But when you look at an ultra debt fund, obviously it's a long-term horizon and it has to be a little aggressive. And then the money that you plow in the markets and you put it along with government securities, obviously that works in all, because they invest too much in government securities and CPs and commercial papers. Unlike an FD, which is like a simple instrument where you are guaranteed for whatever term that you are being given, there will be no change based on any kind of a change in the repo rates or in a change in the interest rate cycle. So I think between the two today, if you just want to have a liquidity FD slash, I would say you can look at a liquid fund. If you looking at a long-term return, maybe the other option could be beneficial from a customer standpoint. But the returns, I would say, still is better in, I would say, liquid fund right now, and it's still lesser in FD, because the amount of repo rate change that has happened, that is still not translated into the FD rates hike. You have seen in the rate hikes in home loan immediately or personal loan from a retail assets, but FD takes a longer time depending on the liquidity position of the bank. So most of the FDs are still not in the range of 5.5, 6 right now. It's still at 3.5 to 4.5 to 5,
Right.
in the case of the tenures.
So, Pankaj, what's very important also over here to consider is the post-tax return that we are talking about. Even if FDs have really not have reached that stage where we want them to in terms of interest rate, but then the post-tax returns, considering fixed deposit, liquid and ultra short term, which is more investor friendly according to you?
So in a FD, you have a straight tax slab that is charged. So there is nothing that changes. If I am at 30% tax slab, in whatever my interest on FD comes in, it will charge at 30%. But if you look at a liquid fund, if it is within 36 months, your tax rate will be a short term, your short term, which is like about 20%. I would say long term. And when you cross the threshold of about 3 years with these guys, it's a long term capital gain, which is at 20%. So depending on if it's within 36 months, you will have to pay exactly what is your tax rate is and tax slab you fall in. But if it is crosses the threshold of 36 months, you can pay a 20%. So if I am a consumer whose tax slab is already at 30%, I would recommend that I hold on to this particular, liquid fund or my, ultra debt fund for 36 months plus. Then my 10% saving on my tax slab will come. So it depends on the tenure on which you do it. But FD is straightforward, 30% on, or if I'm a 30% slab, it will directly be concentrated into your tax slab rates.
Okay, just a very basic question in order to help understand people why is it important for them to let your money grow. If I just park in, considering the revised interest rate on their savings account, which are going upwards, for all those people who just think that having your money parked in your savings account means your money is growing, what would you tell them? What is the money making chance that they are losing on? And we are looking at interest rate hikes now, but then this has not been the case always, and this might not even be the case if you look at a larger picture of the interest rate story in the country. I mean, for now it is likely to go upwards, but then definitely it's not going to stay there for a very long time for you to decide that a savings bank account is the only way to park my money in and to just earn a lot of profits out of it. What would you like to tell or advise those kind of investor who believe a lot in a traditional instrument like a savings bank account?
So when you look at a savings bank account, right, this bank account is more for payments perspective and all that, not for money making or investing. You don't
Sure.
make returns from a savings bank account. That's point number one. Point number two is that today your inflation is about 7.5. If it and the guidance that RBI has already given, it will not go down very soon. So my inflation, any which is giving me a negative return when I'm comparing against saving account bank interest rates. It's a negative return that I'm getting on my asset. Point number three is that even this interest rates, if even the repo rates rises, today it's 1.5.9, you will not see a drastic change in your saving account rates, which will happen because, as I told in the first question itself, your liquidity position of the financial institution is dependent on the kind of interest that they give it to the consumers. Unlike retail assets, where you directly pass on that repo rate benefit or the negative repo rate benefit to the customer. So in this case, I would suggest to the consumers that there are better schemes in the long run scheme of things to make positive return as compared to inflation. Because the benchmark when we look at return on your assets is basically against inflation. So if I am 7% at inflation right now, which I'm trending maybe for 6 to 12 months more, and my repo rate still maybe rising 50-60%, still I will not be able to cover with my FD rates or saving account rates in terms of the inflation deficit that I can see, the return on investment that I see. So I still, as an investment tool, will not suggest for consumers to look at saving bank account, but for payments, building works, getting something else, is a it's more of a payment tool and that perspective, not from me as an investment tool.
All right, one last question and then we wrap up this discussion. Pankaj, how do you select a liquid fund and an ultra short term debt fund right now for yourself? What are the do's and don'ts, or what are those guidelines that you would like to give our viewers?
So I would say there are three basic principles that every consumer should follow. One, they can look at a return what is being given on the particular debt fund for the last 3 years, 5 years, depending on the horizon that they have. So one is return on that particular fund. Second is in terms of the exit load. What is the exit load that they are charging on that particular fund? Because tomorrow if I liquidate, how much is my exit load? Because normally in a debt fund, the exit loads are lesser than your exit loads in your normal equity funds, right? So exit load is an important factor. Second is the return that you make on that particular liquid fund is something that you look at it. And third, maybe I would say in terms of the tenure is you can decide on what kind of tenure you can look at it with that particular liquid or a ultra fund that you look at it. So these are three factors which can weigh in and you can decide on what kind of instrument you take and invest.
All right, Pankaj, thank you so much for joining in and explaining our viewers as to why should be they moving on from savings bank account, even if they're saying the interest going up over there, and which are the better options for them to park their money. Thank you so much, Pankaj.
Thank you.